Okay, hi, this is Tim Turner, Torrid Technologies, and welcome to another one of our Turbocharge training videos. This one, we're going to talk about required minimum distributions again. We talked about sort of the beginner's version previously, the basics, and now we're going to talk about advanced. Okay, so first of all, in the basics, you probably saw how we went into the retirement view and that required minimum distributions are already calculated by default from anything you enter in the tax-deferred qualified bucket. Okay, you can print those out, you can view them on the spreadsheet, and they just do basic RMD calculations. Now we're going to go to some more advanced calculations. So today we're going to talk about the advanced RMDs. I'm going to give specific demos of each example using another suite of software that we offer, and I'll take any questions that you have. Okay, just a quick review. RMDs, as people call them, that stands for required minimum distributions. Most of you already know that. The IRS requires these distributions from qualified accounts, and generally qualified accounts were tax deferred, and so the original contributions were never taxed. And that includes 401k plans as well as traditional IRAs. There are some other accounts as well. I'm not going to list them all. And basically the IRS wants their taxes. They don't want people that have a decent amount of money or a big pension to sit on that money. They want to get some taxes out of it. Helps them pay for other things, basically. The RMDs are required when the client reaches age 70 and a half. That's when we have to start taking the RMDs, and there's penalties if you don't take them. Okay. Let me just go back. Okay, yeah, that's all I had. We went over a lot of the rules under the basic RMDs video, so go back to that one if you need more on RMD rules. And here are the types of advanced illustrations that we have. We have three types. The first type is owner only, and that's where the owner of a qualified account is still alive and has to continue paying RMDs. Or possibly they didn't have a beneficiary and the account gets paid out. This is really more like the calculations in the retirement view software, but I've got a couple of wrinkles in it in the illustrations that I'm going to show you. The second type is owner plus a spouse, and that's where the owner owns the account but the spouse is the beneficiary. So if owner passes away, the account goes to the spouse. The spouse can then use their birth date to change the schedule of RMDs using their own life expectancy. Okay, so if they really don't want to take the money, they can, and the spouse is younger, then they can probably reduce the RMDs. You know, many times people just liquidate the accounts, and so that's not the case here. We're talking about actually continuing to take the minimums. The third type of advanced illustration is the owner passes away, the account goes to the spouse. The spouse then changes the account into their life expectancy, and then they have multiple beneficiaries, probably their children, that the account goes to at that point. This is also known as a stretch IRA or a stretch account, and we're going to talk about that as well. So let's go ahead and dive into our examples, because hopefully you'll find those to be interesting. I've got to go to the right piece of software though. Okay, here we go. We're going to go into my browser, and this is another suite of software we offer, WebCalcs for advisors. It's on a web page that you can go to, and you can find out all the different systems. I'm going to go ahead and log in to my account, and I actually already logged in before this call, so it looks like it already logged me in. This is also the Torrid Tech Customer Hub account dashboard, if you will, where you can edit your mailing address, billing address, view subscriptions. You can print out old receipts. You can make a payment if you still owe a payment on a subscription. If you have a subscription to the WebCalcs software, then you'll see this tab, which I just clicked on. And then you'll see these 11 different tools here. And you can go to WebCalcs for Advisors if you want to look at that. I'm zooming in so we can see a little better. Cost of waiting, we got a number of distributions, paycheck analyzer, risk tolerance, Roth conversion, a basic college savings tool. There is a little retirement tool, but it is nothing like the retirement view. It's very, very simplistic. Okay, so let's go to our first distribution tool for RMDs, owner only. So I click on that tool, you get to this page. And I'm going to try and zoom in so you can see it best you can. So you start by entering your client names. In this case, we just have an owner and no spouse, so I'm going to put in Thurston Howell III. And let's say that he was born in 1936. Let's say, no, actually, let's make him a little younger. Let's say he's born in 1945. All right, let's say he has $300,000 in his account. Well, that's $3 million. Let's say he's got $300,000, and he's not contributing to it right now. Say he's getting a 6% return. Enter desired report format. We can do either HTML or PDF. HTML, we can review it on the screen. So I'm just going to do that and click Calculate. And as you can see there, we can generate a simple report. You could print from here, although you'd be better off printing from the PDF. Okay, so it recaps the inputs that you made, their birth date, when they're going to, how old they are, when they're going to turn 70 and a half. Okay, so this person was only a year or two from their RMDs. So then we have our life expectancy factor. It automatically uses the uniform table, and it calculates the RMD and adjusts the account balance. Now we had a 6% return, so that's factored in. And then we have a cumulative amount of the distributions. All right, so if they just continue taking that. Now in this case, we don't put in an ending point for the life expectancy. This just lets you, there's an owner and we don't know when they're passing away, so it just runs the schedule out to the end of the life expectancy table, which is at 115. Okay, so there, that's a very simple illustration. You can see that if they ran it all the way out, they got about $900,000 out of the $300,000 account. So it got the RMD stretched it out by $600,000. Okay, so I'm going to go back and I'm going to try to do the PDF. I'm not sure if my browser's configured right. I'm hoping it is. So let's go with that. We're going to open it in Adobe Reader. Okay. So I've got that in Adobe Reader. Let's see if we can make this bigger. Okay, so you see the nice PDF that these WebCalcs produce. There's a nice cover page. It has the client's name on it. It has your contact info. Well, how do we get that? Because I didn't fill that out. Well, because you got a subscription. We know who you are, and we have you on our customer client database. And it pulls your active contact information out of there and puts it on the cover page. Okay, so let's look at the results. So the PDF looks very similar to what you saw online. It has a table of the RMDs. It has, the other nice thing though is it has the date. It has a nice header and footer, and it has a lot of the same information, and just gives you a nice printout that you could give your clients. So there you go. There's a very simple RMD report. I'll tell you what, I'm going to go ahead and save this report. If anybody wants a copy of it, I can email it to you. I'm just going to go to Documents, and I'm going to put in there a new folder, WebCalcs sample reports. All right, open that up. WebCalcs report, RMD, owner only. All right, so we got that one in case we want to use that. Okay, now I'm going to go back. So if there's any questions about that, let me know. I'll filter through them if you have any questions. Let's see. All right. Okay, I'm going to go back and I'm going to do the owner plus the spouse. Okay, so let's do Thurston and Lovey Howell III. Actually, I'm not going to put an ampersand in there. I know on the internet doesn't like ampersands because they're used for something else. And let's make this people a little younger. Let's say 1955. Let's say there's a spouse and she's got a different birthday. Maybe she's younger. Let's make her 1959. Let's say we still have 300,000 in there. And let's say they are contributing, I don't know, 5,000 a year till they retire, 6% return. And again, before I jump to the PDF, I'm going to kind of verify my results just to make sure I entered everything correctly. Okay, so here we recap the owner and the spouse, their birth dates, how old they are by the end of the year. We got an age difference calculated. Okay, so then we get to our little calculations. The first section starts off with the owner's life expectancy. And now in this case, we do use the life expectancy. We assume they reach their age 70 when the RMDs start, and we use their life expectancy, in this case, to age 85, and then we assume that the owner passes away. At that point, we switch to the spouse, who's younger. So at that point, we're switching to their life expectancy. Okay, and then the RMDs drop a little bit. Okay, and then when the spouse passes away, then you have 5 years to distribute all that's left. Okay. Now in this case, we didn't show any other beneficiaries. It just shows a schedule, an automatic 5-year payout. All right, because you would have to do some stuff to make that happen to go to the beneficiaries, and we'll see that in the next sample. So these tools aren't very hard. If you can fill in the blanks, you can generate an advanced illustration that you can share with your clients. Let's calculate the PDF version so we can see how nice that is. This would be the one you'd want to give to your client. Okay, again, we have a nice cover page. And again, we recap our assumptions, and then we go into the calculation tables, which shows you the different life expectancies, how the RMDs are calculated, etc. So you see all that there. It's all in great detail. So if you ever need to run one of these reports, the purpose is that you're not out there hunting and pecking to find something on the internet. You're getting maybe I hear that a lot of guys get these tools from different insurance companies and they're branded for that insurance company. Well, don't do that. You know, you may not even be selling them a product from that insurance company, so why are you going to show the illustration? Keep it branded for you. I mean, these look professional. They'll have your branding and contact info, and you'll look a lot better as their go-to advisor. I'm going to save this report as well. Again, I can email it to anybody that wants to see it. A lot of files in here. Actually, this isn't even my main hard drive. So let's do WebCalcs report, and we'll call this RMD owner and spouse. Okay, so I got that report. Let's see. Okay. Okay, now we're going to go to the last one, the stretch illustration. This is a qualified stretch illustration. All right, I'm going to back out a little bit so we can see all the inputs. All right, we're going to start again with our clients' names and their birth dates. Again, I'm just kind of picking at some random birth dates so you can see that this thing isn't canned or anything. This thing really works. You put in their balance as of the end of the prior calendar year. How much are they contributing? I think we said $5,000 a year. They're getting a 6% return. And then we come down here to our contingent beneficiary table. You can put up to 5 beneficiaries in. So we have John, my son, and Susan, my daughter. Okay, so let's say we just change these birth dates a little bit just so you can see some differences. I'm just changing these a little bit. And right now we have them 50-50, which is very typical. Maybe they have 3 or 4 kids and it gets a little more complicated. Let's go ahead and calculate so we can see what this looks like. We have licensed these tools to some big companies, and when we did that, they wanted to see different illustrations at different rates of return and whatnot. This one's pretty simple. It doesn't do a bunch of different rates of returns. Some insurance companies wanted to show a 0% illustration instead of a 6%, or to show both. So you can do that. You can create a 0% one and then a 6% one and show them both. And no, this isn't product specific. We aren't mentioning any specific insurance products or anything. So it's just a generic calculation. Okay, so again, we have the account owner. It goes out to their life expectancy. Then it rolls over to the spouse for their life expectancy. And at that point, we then roll what's left, and we split it into 2 accounts for John, the son, and Susan, the daughter. Okay, and then we continue the RMDs. So we're assuming that John and Susan aren't going to go on a big buying spree and get a boat and a new car and take some vacations and maybe get a new house, etc. That they're set on their own and they're just going to take the minimums and use that as some extra income. Maybe just take an extra vacation every year or something. And then we get down here to the legacy distribution summary. We had the initial account value of $300,000. At the death of the spouse, the account was still at $627,000, which we then split between Susan and John. And then we continue the RMDs, and the total of all those RMDs is $2,177,000. So we had a stretched amount of $1.8 million or so, and the percentage of the initial account value is 725%. So it's quite a decent stretch there. There's a bunch of legal disclaimers on here. So that's the web one. You can kind of check your calculations. You want to print it, we go back, click on PDF, click Calculate. It should then ask us if we want to open it in a reader. All right, so it takes a few seconds to calculate that. Notice it's building this nice PDF document on the fly. Just there in a few seconds it built this thing. So I have stretch distributions qualified. And again, we recap the inputs and show the owner, account owner, and the spouse rollover. And then we go to the children there. All right, let's see that. And our disclaimers. I think we can add more disclaimers if you want to add more, but for now there's just these basic ones. But again, it just illustrates the main points of how the stretch works. and how that's useful. Okay, let's save this one as well. File save as. I'm going to go to Documents, go to my WebCalcs folder, and I'm going to call this my stretch qualified. Okay, so that implies RMD, but I'm going to go ahead and put RMD stretch qualified. Okay, so that's where you come into the contingent beneficiaries. All right. Any questions? Any questions? If you have any questions, please enter it into the chat box there. Okay, I already, actually this is not really that much of a different slide. I'm just going to show the samples. And if you have any questions. I have a couple of questions that I'm going to wait and answer later. I'm not really sure what they're asking, so I'm not going to put it on the recording. So for now, I'm going to wrap this up. I hope you learned something about advanced required minimum distribution calculations. The main thing is not to try to do them on your calculator and probably even in a spreadsheet. It's much easier to have a professional tool that's been reviewed by compliance departments and that runs the right calculations. So consider that, and thanks for listening, and we'll talk to you again on one of our other videos. It's Tim Turner from Torrid Technologies signing off.